Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by realcrowd.com. It is crowdfunding with the professionals. Check them out at realcrowd.com. Well, today we're talking about emerging trends in real estate. It's the ULI PwC, a report that comes out each year. Our guests are Mitch, Roschelle, and Byron Carlock, and they're with PwC. They lead the real estate world there, and they're partners. And gentlemen, we talked about kind of the overall view, and I think one of the things that people are curious about is, what are the expectations moving forward? How long is commercial real estate and real estate going to be profitable? And you do the report, you talk to a lot of people. What's the sentiment?
Yeah, you want to take that?
No, I think the big news is we don't see a big correction or crash coming anytime soon, and the next one will not be real estate's fault.
Good.
The sentiment's pretty high, and you'll see in the graph just how it's continuing, but it's not that abnormal.
Yeah, but what's interesting is we ask the market participants in our survey every year, what are the prospects for profitability for the upcoming year? We don't define the word prospect, we don't define the word profitability, and we let them, and it's a 1 to 5 scale. 1 is abysmal and 5 is excellent. And one of the things we've seen is that it's sort of plateaued where people are feeling strong about it, which is the good, people are saying good, which is 4, and 5, which is excellent. And 2 years ago, I got really nervous because the sentiment in 2007 looked identical to the sentiment in 2017. I was like, well, we all know what happened in 2008, but we've gotten past that, and we'll talk more about where we are in this recovery. One of the things we have observed is the folks that were saying good were growing in number, and the folks that were saying excellent were kind of shrinking in number. So maybe we thought people were starting to back off a little bit, but that's leveled out. And to Byron's point, people feel that maybe this is one of those recoveries that's just going to go a lot longer than others. One of the things we also looked at is past recoveries and what was going on in those past recoveries. So if you go back like to the Lincoln administration, you'll notice that economic booms and busts were frequent and short. If you get into the modern era, into like the 70s, you notice that economic booms and busts were longer, but not as long as the recovery is today. But one of the things you experienced in those recoveries was GDP growth and employment growth at a greater level. You get into the recovery that we're currently in. Now, GDP has jumped up dramatically in the past year, maybe year and a half, relative to where it had been in the past. But job growth had been relatively small, and that's when we first started to see a jobless recovery. So one of the things we had observed was it's possible that real estate participants were actually enjoying the fact that the economy was growing, but growing very slowly, so that they didn't get ahead of themselves. And
here we are with a relatively healthy supply-demand across all the major product categories, and in an environment that is continuing to elongate, and frankly looks like it will elongate more because the capital markets have been disciplined. There's not been overbuilding in any demonstrable sectors. We're still underhoused. 29 million millennials still live at home. And when you benchmark it against other economies,
good thing my kids aren't millennials, they're Gen Z. You just scared me for a second.
and if you look at this in context of other countries, we've got a great chart that will show.
Yeah, I think this is interesting because what is this, the second longest recovery cycle we've had in the U.S., right?
Yeah, this is the second longest. We're about to surpass the longest. As we air this, we're at 112 months. The longest is 122 months, which seems long, and people are starting to get nervous that we're bumping up against that deadline, if you will, and people are starting to say we're late in the recovery, which is possible. But let's put this into some global perspective. Since 1991, Australia's been recovering. They're now in month 324. Okay, so that's almost,
but it's still with positive GDP growth across that whole time.
3.2% GDP growth over that time period. South Korea, 4.4% GDP growth, 240 months. We talked before the show started, and we were sort of commenting on what could be the thing that derails a recovery. Well, let's just think about South Korea for a second. Think about Canada, our neighbor to the north, firing rockets over our heads, if that wouldn't slow down our economy if it happened. But that's what North Korea and South Korea had been doing up until recently, and that didn't slow down their 4.4% GDP growth. Ireland, I'll leave you with this one, which Ireland people think of as a boom-bust kind of thing, because Ireland did have some massive expansion, but they have continued to expand. They're at 234 months with a 5.9% average GDP growth over that time period. So it's possible that the slowness of our recovery is the thing that's
elongating it.
Going to catapult.
Yeah, and think about it, we're continuing this with increasing interest rates. We are watching, as Mitch pointed out, the sentiment has shifted. There are more that have said good and fair, and it's not a euphoric sentiment, but it's a optimistic sentiment. Only 1%, less than 1%, think it's going to be a bad year in 2019.
Yeah,
right?
I always joke. I used to, when I would put that chart up when I'd speak around the country, I would refer to the person who said abysmal as one bitter dude. A couple of years ago, I looked into it, and apparently it was 17 bitter people.
17 bitter people.
17 bitter people. And they were 16 men, 1 woman. We did know that. Last year, it went down to 16 bitter people. And I'm really thrilled to announce that now we're down to 15 bitter people. I can't tell you who they are, or I can't tell you whether or not they're the same bitter people.
I wasn't one of the bitter people.
I think it's actually people who just clicked the wrong box on the survey. When 2,400 people respond, there's always going to be a couple of errors.
Yeah.
But no, I think the sentiment is, and the economics of our economy, that was redundant, is really what's driving us forward. And Byron used an important word before, and I want to bring it back, which is discipline, which is the lenders, the investors, and Michael, to the point you made in the previous segment, when you have the degree of transparency and accountability that we have today, and when you have folks that are in roles where they're acting as a fiduciary over the money that's being invested, you get behavior that's very responsible. And that's why we have the market we have today.
And interestingly, as you say that, it reminds me that the industry has also matured to offer each capital pool a product that suits their own needs. When you say commercial real estate, you now get to choose between, do you want a debt strategy, an equity strategy, a public strategy, a private strategy, opportunistic, hoping for big returns, down to value add, then core plus, and then core, as well as product decisions across office, industrial, retail, multifamily, hospitality, self-storage, data centers. And each of those is evolving in the type of product that's relevant to tenant demand today. And investors can choose the buckets that they want for the return they're willing to.
You left off cannabis. That might go up in smoke.
Yeah, that's just, there you go. Yeah, we're not going to eat that one. In any event, what's interesting is listening to you, Byron, you discussed investment strategies. You did not classify the type of investor. And every word that came out of your mouth, all of which were correct, could be applied to the most seasoned institutional investor, foreign or domestic, or a retail investor.
A retail investor.
Who can access those products and those strategies through REITs, through ETFs, through a whole bunch of different channels.
Which even 25 years ago was not available to
them. And you mentioned crowdfunding, or at least we were talking about it during the break. In fact, crowdfunding, which hasn't really taken off, as big as its potential, but I think it's making great progress. Crowdfunding is another way to play on the debt side of that. Crowdfunding allows you to democratize investing in debt.
Yeah.
And it will have the degree of transparency and accountability. So there's no end to where this heads, and I'm encouraged by.
What about the economy?
Yeah.
How long is it going to be great? What are some things that could derail us? What should we expect moving forward there?
What's really interesting, we were trying to understand where GDP growth is and where it's come from, and what are the components of GDP growth. And when we looked at the past boom, the 2001 to 2008 recovery, so much of that was driven by housing, or at least the presumption that housing was important. If you go back 40 years and you look at the role that new housing construction has played to driving GDP growth, it's relatively small. And the thing that's fascinating, if you look over time, is, and we're going to talk about employment probably in the next segment, but if you just look at just the underlying economy, how important the consumer has been to the economy over that 40-year period, that really speaks to the durability of our recovery.
Indeed.
And the real estate asset class being in a position where it supports the consumer. So it's not just retail, which we'll talk about some more. It's office, it's multifamily. All of those play into the consumer. That's 2/3.
Logistics and supply chain.
All of that. And so as our economy evolves and as the nature of what we do in our economy evolves, the fact of the matter is the consumer is the constant across all of that and will continue to contribute to the growth of our economy.
Well, and to that point, the consumer is changing the way they use space, which is only elongating this cycle as developers and investors respond to those changing tastes.
So how long can I do the Snoopy dance about a great economy?
So I'll just say one thing, because I'm not going to answer that question for fear that somebody brings it up and beats me over the head with an answer that is on videotape. Yeah. But the fact of the matter is, you've been using the expression Snoopy dance, Michael, for as long as I've known you, and I've never seen you do the Snoopy dance. So
I just did it.
Yeah, no. We want. I know you're tethered to the chair with wires, but at some point, Chase, we need to get that. Get him on videotape doing that. Maybe like a little emoji that just sails around you, like on your Instagram story of Michael doing the Snoopy dance.
Look, we know there are plenty of things that could go wrong. Geopolitical issues, plenty of things that could temper the growth. What we're saying is we don't see anything that's predicting an imminent crash, and the sentiment index proves that the sentiments are generally optimistic.
Okay, so nothing with midterms, nothing with an election 2 years from now, nothing like that could impact it, you think?
I think it's very hard to predict what the thing is that's going to drive the economy.
Black swan that we all want to predict.
Yeah. And what's interesting is I spent a lot of time looking at the 2001 crash of the economy, or at least what caused a couple of consecutive quarters of negative GDP growth. There's two ways of looking at it. It could have been the events of 9/11 as the ultimate black swan event. It could have also been the dot-com bubble, right? So asset bubbles are something that concerns economists, and I was speaking to a Harvard professor economist yesterday, but you can look at asset prices, whether they be real estate asset prices or stock and bond asset prices, and look at them and say, boy, they're really bubbly relative to long-term trends. But if you look at the long-term trends over a 40-year horizon, and you look at that growth potential that exists going forward, maybe the answer is they're reasonably priced. And by the way, they're reasonably priced because willing buyers and willing sellers are trading at that level, right?
And capital continues to flow.
Right.
So apparently I can do the Snoopy dance into 2019, according to the report.
Yes.
Indeed.
And we don't have the report for 2020 yet. Huh?
No, we don't have it yet. You'll be the first to get it, Michael.
All right. Well, commercial real estate also depends on the sector, right? And on some of the markets. So stay tuned with us. We're going to talk about some of the trends that are impacting the market and expected to impact it moving forward, and talk about some hot markets. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.